Hi there, tax accountants. I hope all is well, and I pray that as you are viewing this video, that you're in the best of health and spirit. This video will cover Chapter 7 Tax Credits from Income Tax Fundamentals 2024. By the end of this chapter, you should be able to calculate the child tax credit, determine the earned income credit, often referred to as EIC, compute the child independent care credit for an individual taxpayer, calculate the premium tax credit available under the Affordable Care Act, apply the special rules applicable to the American Opportunity Tax Credit, often referred to as the AOTC, and the Lifetime Learning Credit, compute the foreign income exclusion and tax credit, determine the proper use and calculation of the adoption credit, recognize other basic individual credits, and lastly, calculate the low income retirement plan contribution credit. So with this chapter, it's going to cover most of the common tax credits. And one key thing to keep in mind is that credits differ from deductions. So as we see here, a credit is a direct reduction in tax liability, whereas a deduction decreases taxable income. Credits are used to target certain groups for tax benefit, and a credit provides equal benefit to all taxpayers. A deduction, on the other hand, is a reduction of taxable income. A deduction reduces tax liability by the amount of the deduction and results in a tax savings that's equal to the deduction multiplied by the tax rate. Deductions provide greater benefits to high-income taxpayers. So if a taxpayer has to choose between a credit or a deduction of equal amounts, generally the credit is going to result in greater savings, again, because credits are a direct reduction in tax liability in comparison to a credit is a direct reduction in tax liability, whereas a deduction is a reduction of taxable income. And to determine the benefit, the tax savings, you would need to multiply the amount by the tax rate. So for the first credit we are going to look at, we will look at the child tax credit. So the child tax credit permits individuals to take a tax credit based on the number of their qualifying dependent children. The child tax credit, it's amidst the temporary expansion due to the Tax Cuts and Jobs Act. There's three significant but temporary changes to the child tax credit. The first is that the increase is $2,000 per child. There's an increased threshold for which the phase out starts, and there's an increase in the refundable amount of the credit for taxpayers whose credit is limited by their pre-credit tax liability. In addition, the Tax Cuts and Jobs Act also added a new qualifying dependent credit of $500 for certain dependents. So in order to qualify for the child tax credit, the child must be under the age of 17. They must be a U.S. citizen or a U.S. resident alien. They must be claimed as a dependent on a taxpayer's return, and they must meet the definition of a qualifying child, as we discussed in Chapter 1. And all qualifying children must have a Social Security number at the time of filing. And there's two parts of the child tax credit. The first part is a non-refundable child tax credit. And with the non-refundable portion, it's limited to the amount of tax liability before taking the child tax credit. As we know, how do we calculate an individual's tax liability? We start off with gross income. We subtract deductions, if any. That gives us our adjusted gross income. And from there, we subtract the greater of itemized deductions or standard deductions. That gives us our taxable income. And from there, it is multiplied, or our tax liability, rather, is determined based on our taxable income. And as we saw before, we can use the tax table, or you use a tax software, and the tax software essentially effectively allocates the tax liability based on the taxable income. Tax law prescribes a pecking order to prevent claiming more than one non-refundable credit. Next, there's the refundable additional tax credit. And this is the amount of child tax credit that was limited by a taxpayer's liability. What essentially happens is the individual gets the amount in excess. So moving back to the non-refundable child tax credit, here where it states that tax law prescribes a pecking order to prevent claiming more than one non-refundable credit, the child tax credit comes after the foreign tax credit, the credit for child independent care expense, education credits, and the savers credits. And then we have this form schedule 8812, which is used by most taxpayers to compute what the non-refundable portion of the child tax credit would be. So here we have this example that states Dante has a tax liability of $2,300 before any tax credits. Dante has determined he is eligible for an education credit of $400 and a child tax credit of $2,000. How much is Dante's non-refundable tax credit? So because his two non-refundable credits exceed his tax liability, Dante is going to take a $400 education credit, and his non-refundable child tax credit is going to be limited to $1,900, right? So we see here the tax liability is $2,300. He has a $400 education credit and a $2,000 child tax credit. So there's a total credit of $2,400, but the tax liability is only $2,300. And based on the pecking order, the education credit comes first, and then whatever's left over in this case will be allocated to child tax, which is $1,900. So as we know, the maximum credit per child is $2,000. However, the available credit phases out when the adjusted gross income, the AGI, exceeds $400,000. And this is for joint filers and $200,000 for all other taxpayers. The credit is phased out by $50 for each $1,000 or part thereof of the AGI that's above the threshold amount. If the taxpayer has less than 3 eligible children, the lower of the following two limitations apply. The refundable additional tax credit, it cannot exceed $1,600 per child, or the refundable additional tax credit cannot exceed 15% of the taxpayer's earned income over $2,500. So if the taxpayer has 3 or more qualifying children, the following limitations apply. The refundable additional tax credit cannot exceed $1,500 per child. The refundable additional tax credit, it's limited by the greater of 15% of earned income above $2,500 or the amount of Social Security and Medicare taxes that are paid up to the unclaimed child tax credit. So as we can see, there's a lot of nuance, but again, there is the schedule 8812, which in essence helps to determine what is the refundable versus non-refundable portion. And if there's a dependent who does not qualify for the child tax credit, they may be an other dependent. So to qualify for the other dependent credit, the dependent must pass the qualifying relative test, be a U.S. citizen, U.S. national, or U.S. resident. A Social Security number is not required. The other dependent credit is non-refundable. The child tax credit and other dependent credit are reported on Form 8812. So in the event that a taxpayer erroneously claims the child tax credit due to reckless or intentional disregard of rules or regulations, they lose the ability to claim the credit for 2 years. And it's extended to 10 years if the Internal Revenue Service determines that the claim was fraudulent. If the IRS rejects the child tax credit for any reason other than math or clerical error, the taxpayer must complete Form 8862 in the year following rejection. And tax preparers, they must complete Form 8867, which is the due diligence checklist. And refunds that are due to the child tax credit, they will not be issued by the IRS until February 15th of the year following the tax year. This allows the IRS additional time to review claims that stem from refundable child tax credit claims. Next, we move on to earned income credit. And as mentioned, it's often referred to as EIC or EITC, and it's available to qualifying individuals that have earned income in AGI below certain levels. The earned income credit is meant to assist the working poor by essentially reducing their tax burden and to supplement wage income through a refundable credit where earnings are less than the taxpayer's maximum income for their filing status. So qualified taxpayers, they'll often receive a refundable EIC even in situations where they have no filing requirement, where they essentially have where they owe no tax and had no income tax withheld. So similar to the refundable child tax credit, the EIC, it can produce a negative income tax. So proper calculation of the EIC requires the taxpayer, they have to answer 3 questions. 1, does the taxpayer qualify for EIC? 2, does the taxpayer have a qualifying child? And 3, what is the amount of the EIC? So there's 7 rules that the taxpayer must meet in order to claim EIC. And the taxpayer, they have to meet all 7 rules. Failure to meet one, that essentially allows the taxpayer to be excluded from claiming EIC. And the 7 rules, they fall into the following categories. So the first is that they must meet AGI limits based on the number of qualifying children. So for those other than married filing joint filers, the limits are as follows. So if they have no children, the phase out starts at 9,800 and ends at 17,640. If they have one child, the phase out begins at $21,560 and ends at 46,550. 3 or more children, 21,560 and phase out ends at $56,838. For joint filers, the limits are as follows. If they have no children, 16,370 is where the phase out begins and the phase out ends at 24,210. If they have one qualifying child, the phase out begins at $28,120 and the phase out ends at $53,120. If they have 2 qualifying children, the phase out begins at $28,120 and ends at $59,478. And if there's 3 or more children, the phase out begins at $28,120 and ends at $63,398. So in addition to determining whether or not the taxpayer qualifies, the taxpayer and the qualifying children must have a valid Social Security number. This is the second of the 7 rules. The third is they're not eligible if married filing separate. Fourth is they must have U.S. citizenship or resident alien status. The fifth is that the foreign income exclusion is not allowed. The sixth is that disqualified income, certain types of investment income must be less than $11,000. And 7, they must meet earned income limits based on the number of qualifying children. So for those other than married filing joint filers, the limits are as follows. If they have no qualifying children, 1 qualifying child, 2, 3, or more, the minimum income earned is $1. However, there's a maximum earned income. If they have no child, it's $17,640. 1 child, $46,560. 2 children, $52,980. 3 or more, $56,838. For joint filers, the limits are as follows. Whether they have no children, 3 or more, the minimum earned income is $1. The maximum earned income if there's no children is $24,210. 1 child, $53,120. 2 children, $59,478. 3 or more, $63,398. And if there's a failure to meet any of these 7 rules, then the individual, the taxpayer, they are not allowed, they are precluded from claiming earned income credit. Another thing that the taxpayer needs to consider is, do they have a qualifying child? So determining whether the taxpayer has a qualifying child, it's important because obviously the eligibility rules, they differ based on whether a qualifying child is claimed or not. So because the rules for defining a qualifying child for EIC, it's similar to the rules for claiming a dependent, right? The key thing is how old is the child? If they're older than the age of 19, are they in school in full time? How much income have they earned? So there's those specific tests that need to be met to determine if it is a qualifying child versus if it is a qualifying relative. In the event that it's a taxpayer with no child, so if the taxpayer doesn't have a qualifying child, the previous 7 rules must be met. In addition, there are 4 additional rules. The taxpayer or spouse, but not both, must be at least 25 years of age, but less than 65. The taxpayer must not be eligible to be claimed as another taxpayer's dependent, regardless of whether or not they're claimed. The taxpayer cannot be the qualifying child of another taxpayer, and the taxpayer must have lived in the United States for more than half of the year, so 6 months or more. And when there's taxpayers with a qualifying child, to claim EIC, there's 3 additional rules in addition to the 7. So if the taxpayer has no child, there's the 7 rules, and then there's 4 additional rules. If the taxpayer does have a qualifying child, it's the 7 rules and then 3 additional rules. So the first, the child must meet the qualifying test is discussed in Chapter 1, and there's 2 exceptions. The child doesn't need to meet the support test, and the child doesn't need to live in a U.S. home for more than half of the tax year. 2, the qualifying child cannot be claimed by more than one taxpayer. Let's say in the case of a divorced couple or separated couple, if one spouse claims for the child and another tried to electronically file their return after, if the return for the first parent was accepted, when the second parent tries to file the return, it is going to be rejected. The qualifying child cannot be claimed by more than one taxpayer, and the taxpayer cannot be the qualifying child of another. So if the IRS rejects EIC for any reason other than a math or a clerical error, the taxpayer will need to complete Form 8862 in order to claim EIC in the future. If the taxpayer erroneously claims EIC due to reckless or intentional disregard of the rules or regulations, then they'll lose the ability to claim the credit for 2 years. And that would be extended to 10 years if the IRS determines that the claim was fraudulent. Any refunds that are due to EIC, they'll not be issued by the IRS until February 15th of the year following the tax year. This, much like the child tax credit, it allows the IRS additional time to review claims that stem from the refundable earned income credit claims. Taxpayer preparers, they are encouraged to prepare and file Form 8867. This is a due diligence checklist along with the tax return. So as we see, there's a lot of qualification rules. So that's why taxpayers and tax preparers, they have been known to make a lot of errors when it comes to determining the earned income credit. So there's numerous checklists, there's aids that have been prepared in order to assist taxpayers with preparing the EIC calculation. And there's what's called IRS Publication 596 that contains an EIC eligibility checklist. As it relates to the amount of EIC that can be claimed, the EIC amount, it must be derived from the EIC tables that are shown in Appendix B. The taxpayer must compare the EIC table amount based on the taxpayer's earned income with the EIC taxable amount associated with the taxpayer's adjusted gross income. And from there, the taxpayer is going to claim the smaller of the 2 amounts. There's new EIC tables that must be used each year. They're adjusted for inflation. EIC is reported on line 27 of Form 1040. And for taxpayers claiming a qualifying child, the Schedule EIC must also be used. Next, we move on to the Child Independent Care Credit. So, Congress enacted tax laws to provide benefits to taxpayers that have dependents, but they need to be provided with care and supervision while the taxpayer works. So, taxpayers, they're allowed a credit for expenses for the care of their children and other dependents, and they use Form 2441 to determine this calculation and report the credit for child and dependent care credits. In order to be eligible, the dependent must be under age 13 or a dependent or spouse of any age who is incapable of self-care. If a child's parents are divorced, the child does not need to be the dependent of the taxpayer claiming the credit, but they must live with that parent more than with the other parent. Qualified expenses, these include amounts that are paid to enable both the taxpayer and the spouse to be employed. Qualified expenses, it essentially includes amounts paid for in-home care, such as a nanny, as well as out-of-home care, such as a daycare center. Overnight camps, however, do not qualify for the credit, nor do activities providing standard education such as kindergarten. So, day camps such as soccer camps, music camps, math camps, dinosaur camps, they do qualify for the credit since they're not considered standard education. In the event that, let's say, payments are made to relatives, these are considered eligible for the credit unless the payment is made to a dependent of the taxpayer or to the taxpayer's child that's under the age of 19 at the end of the tax year. So, something to keep in mind. In order to claim the credit, the taxpayer must include in their tax return the name, the address, as well as the taxpayer identification number, the TIN, which is either the social security number if it's an individual, or the EIN of the organization that is providing the care. As it relates to the allowable credit, so whenever there's taxpayers that have an AGI of less than 15,000, the child independent care credit is equal to 35% of qualified expenses. For taxpayers with AGI greater than 15,000, the amount of the percentage, it decreases as income increases. The maximum amount of qualified expenses to which applicable percentage can be applied is $3,000 for one dependent and $6,000 for two or more dependents. And Form 2441 is used to calculate and report the credit for child independent care expenses. Married taxpayers, they must file a joint return to claim the credit, and the credit is limited to the lesser of either spouse's earned income. And to claim the credit, full-time students and disabled taxpayers with little or no income, they are deemed to have income of $250 per month for one dependent and $500 per month for two or more dependents. So here we have an example. It states, how much is their 2023 child care credit? Caitlin and Owen are married and file jointly. They have 3 children and pay $18,000 for child care expenses during the year. Caitlin earns $84,000 and Owen earns $40,500. How much is their 2023 child care credit? So the qualified expenses we see here lets us know it's $18,000. It says they have 3 children, but we know the maximum for more than one dependent is $6,000. Based on their income, the credit percentage allowed from Form 2441 is 20%. So it starts off, the highest rate is 35%, and the lowest rate is 20%. And again, if I don't want to say phases out, it decreases based on the level of income. Next, we move on to the premium tax credit, which was enforced by the Affordable Care Act. So with this Affordable Care Act, this is essentially where eligible taxpayers, they have the opportunity to receive a tax credit, and the ultimate intention is to lower the cost of healthcare. So the Affordable Care Act, ACA, or often referred to as Obamacare. It contains a number of different provisions that affect the taxpayer's income tax liability and reporting. So to be eligible, taxpayers, they need to meet the following requirements. Health insurance must be purchased to the state or federal exchange. The taxpayer should not be eligible for coverage through employer or government plan. The taxpayer should not file a married filing separate return except under very limited conditions. The taxpayer cannot be claimed as a dependent by another. There are some specific tables that are required to compute the allowable credit. And the premium tax credit, it's intended to take the form of the lesser of the following: the actual healthcare premiums that were paid, or the benchmark plan premiums, less the amount that the taxpayer is expected to contribute to healthcare. The premium tax credits, they can be paid in advance or when the tax return is filed. So now a lot of times when you file a tax return for a client, they would need what is called Form 1095A. So previously in recent tax years, maybe about 2-3 years ago or so, what will happen is that you will file a tax return for a client. Then several months later, maybe a year later, they will receive a notice in the mail saying, hey, you didn't include Form 1095A with your tax return and it needs to be amended. Now, however, if you file a tax return for a client and they should have received the Form 1095A and it was not included, then that tax return would be rejected and it will not be accepted until the client provides the 1095A and that information is reflected on the tax return. So the advanced premium tax credit and actual premium tax credit, they're reconciled when the tax return is prepared. If the advanced credit is greater than the actual credit, then the difference is treated as an additional tax due on the taxpayer's return. And if the advanced credit is less than the actual credit, then the taxpayer would get a refundable portion of that credit. And this will be reported on Form 8962. Next, we move on to our education tax credits. So the tax law contains a number of provisions that are intended to reduce the cost of education for taxpayers. And the educational credits represents some of these provisions. This includes exclusion from gross income for scholarships, employer-provided education assistance plans, tuition reduction for school employees, deduction of business educational expenses, student loan interest deductions, qualified tuition programs, often referred to as 529 plans, Coverdell educational savings accounts, American Opportunity Tax Credit, and the Lifetime Learning Credit. The American Opportunity Tax Credit, often referred to as the AOTC, it's an education credit that's available to help qualifying low-income and middle-class income individuals help to offset the cost of higher education. So the American Opportunity Tax Credit is a credit for students in their first 4 years of post-secondary education. So the AOTC can be claimed for expenses of students that are pursuing a bachelor's or an associate's degree or vocational training. In order to be eligible, the student must meet all of the following. They must be pursuing a degree or recognized credential. They must be enrolled at least half-time for one semester, quarter, trimester, etc., starting during the tax year. They should have received Form 1098T from the eligible higher educational institution. They should not have completed the first 4 years of higher education at the start of tax year. They should not have claimed the American Opportunity Tax Credit for more than 4 years, and they should have no prior felony drug conviction. Meeting either of the following criteria precludes, it basically causes them to not be eligible for claiming the American tax credit. And this is if they are married filing separate or if the taxpayer is listed as a dependent on another return. The American Opportunity Tax Credit that depends on the accurate computation of qualified higher education expenses. So the following expenses don't qualify: room and board, do not qualify. Non-academic fees do not qualify, and any expenses not related to the student's course of instruction not qualified. Qualifying expenses, they must be reduced by any tax-free scholarships, grants, or other educational assistance, and it must be paid during the tax year for education during an academic year beginning within that tax year. The maximum annual credit for the ALTC is $2,500 per student, and it's calculated as 100% of the first $2,000 of qualified expenses paid and 25% of the next $2,000. However, the ALTC, it does phase out. It's phased out for joint income filers that have income between $160,000 and $180,000, as well as single head of household or qualifying widowers that have income between $80,000 and $90,000. The American Opportunity Tax Credit, it is 40% refundable under certain conditions. In the event that the IRS rejects the ALTC for any reason other than a math or a clerical error, the taxpayer, they will need to complete Form 8862 in order to claim the ALTC in the future. If a taxpayer erroneously claims it due to reckless or intentional disregard of the rules or the regulations, then they lose the ability to claim the credit for 2 years. And in the event that the claim was fraudulent, that loss of ability to claim the credit is extended to 10 years. Unlike the child tax credit and the EIC, there's no time restriction on the issuance of refunds from the IRS. Tax preparers, they must prepare and file Form 8867, which is the due diligence checklist, along with the tax return, and failure to file may result in a $600 penalty. Next, we move on to the lifetime learning credit, because some people, they don't just want to stop at their bachelor's or their associates or a vocational degree. Some people want to seek out higher education. The purpose of the lifetime learning credit is to encourage taxpayers to enroll in courses at eligible institutions to acquire or improve job skills. The maximum lifetime learning credit is $2,000, 20% of qualified expenses up to $10,000. The lifetime learning credit is available for qualified expenses that are paid for education or taxpayer of the taxpayer spouse and dependents. It's available for undergraduate, graduate, and professional courses at eligible education institutions. It's non-refundable. It has no requirement for course load. The student can be enrolled in just one course and still be eligible for credit. Has no limit on the number of years that the taxpayer can claim the credit, and it's not subjected to felony drug offense restrictions. So we see with the ALTC, that one is $2,500. The lifetime learning, this one is the maximum amount is $2,000. As it relates to the lifetime learning credit, it does phase out, however. So for joint filers between income of $160,000 and $180,000, they will experience a reduction. For single head of household or qualifying widower, and taxpayers with income between $80,000 and $90,000, there's also a phase out. So as it relates to using both credits, taxpayers, they cannot take both the American Opportunity Tax Credit and the lifetime learning credit for the same student in a tax year. So the choice in one year, it doesn't bind them for future years. So this year you might decide, hey, you know what? I meet the rules for American Opportunity Tax Credit, and I also meet the rules for lifetime. You essentially take which one will yield the better result. So thus the taxpayer, they can claim ALTC for a student in 1 year and claim the lifetime learning credit for the same student in the following year. Both the American Opportunity Tax Credit and the lifetime learning credit, they're claimed using Form 8863. So here we have this example, and it states, what amounts can David and Vivian claim as education credits assuming no scholarships? States David and Vivian's tax status is married, filing jointly. They have 2 dependent children and an AGI of 72,000. Their son Steve is taking 4 credits part-time enrollment at Baton Rouge Community College. His tuition fees are $4,200. His tuition and fee, perfect, $4,200. David and Vivian's daughter, Cora, is a freshman at Tulane University. Her tuition and fees are $32,200. Neither child has a felony drug conviction. What amounts can they claim? So Sean cannot take the American Opportunity Tax Credit. Why? Because he's not enrolled at least full-time. So that's one of the key things. Needs to be enrolled full-time. However, he does qualify for a lifetime learning credit. So the 4,200 times 20% gives us 840. Corey, on the other hand, does qualify for the American Opportunity Tax Credit. So as we see here, 2,000, the first 2,000 is 100%, and then the following 2,000 rather is subjected to a 25% limit. So based on this, Vivian and David, they're allowed to take $3,340 in total education credits. So the below the phase-out limits for both credits, so they get the full amount since their AGI is below the limits. Next, we move on to the foreign exclusion and tax credit. International taxation can be a very complex area of tax law, right? So there's two main provisions, however, that's related to the U.S. taxation of international income that apply to individuals. The first is the foreign income exclusion, and the second is the foreign tax credit. With the foreign income exclusion, this allows certain taxpayers working and living outside of the U.S. to exclude a certain portion of foreign income, as well as certain foreign housing from taxable income. And the exclusion limit is $120,000. The foreign income exclusion is claimed on Form 2555. As it relates to the foreign tax credit, expats and investors whose income are subjected to foreign taxes, they may use a foreign tax credit to reduce their U.S. tax liability. The amount of credit is limited to U.S. tax that applies to that income. And it will be calculated as follows. It will be based on the net income, which would be in the numerator, divided by the total taxable income. And from there, they multiply it by the U.S. tax liability. With the foreign tax credit, it's typically claimed on Form 1116 unless the taxpayer meets all of the FIRE requirements. All foreign source gross income was passive categories. This includes most interest and dividends. All income and any foreign taxes paid on it were reported on a qualified payee statement. So for example, 1099 DIV, INT, Schedule K, etc. Total credible foreign taxes aren't more than 300. And if all requirements are met, then the foreign tax credit is going to be entered on Schedule 3 of Form 1040, and then that amount is going to transfer over to the 1040. One thing to keep in mind is that the refundable tax credit, it is non-refundable. And then here we see if there's, let's say, an unused credit, then it is carried back 1 year or carried forward up to 10 years, so you don't necessarily lose it. Here it says, what is Joseph's foreign tax credit for the current year? It states Joseph Steele had $200,000 income from the U.S. and $100,000 income from employment of Lithuania. He paid $40,000 in Lithuania taxes. Assume his U.S. tax liability is $85,069. What is Joseph's foreign tax credit for the year? Here we have the formula. In our numerator, we have the net foreign income of $100,000 divided by our denominator, which is the $300,000. And we have the U.S. tax liability, which was $85,000. So we multiply, it's like we pro-rated the amounts. So based on a pro-rata amount, there's a credit of $28,356. And the unused portion of the credit which is the $40,000 in foreign taxes paid less the $28,356. It's carried back 1 year or carried forward up to 10 years. We move on to adoption expenses, and taxpayers are allowed 2 tax breaks for adoption expenses. A tax credit is allowed for qualified adoption expenses that are paid by taxpayers, and there's an exclusion from W-2 income that is allowed for qualified adoption expenses paid by the taxpayer's employers. So individuals are allowed an income tax credit for qualified adoption expenses. The adoption credit is reported on Form 8839. Total credit that can be taken for all years with respect to the adoption of a child is $15,950, and this credit is the total amount for each adoption and not an annual amount. The amount of credit is reduced for taxpayers with AGI over $239,230 and fully phased out when the AGI reaches $279,230. The adoption credit is non-refundable, and the unused portion may be carried forward for 5 years. And to claim the credit, the married individuals must file jointly. And then lastly, the taxpayer, they can't, or they would need rather, to provide their name, age, and the TIN on the child of the return. We have what's called a domestic multi-year adoption, and if a child is a U.S. citizen or a U.S. resident at the time the adoption is commenced, the credit for qualified adoption expenses is allowed for the tax year that follows the year that the expenses were paid or incurred. And if the expenses are paid or incurred in a tax year that the adoption becomes final, then the credit is allowed for that year. The full $15,950 credit it's allowed in special needs adoptions, regardless of the amount of qualified adoption expenses that are paid. With the foreign multi-layer adoption, if the child is not a U.S. citizen or they're a U.S. resident at the time, or not a U.S. resident at the time of adoption, then the credit for the qualified adoption expenses is not available unless the adoption becomes final. The credit for qualified adoption expenses that were paid or incurred in the tax year that the adoption becomes final, or in any earlier tax year, it's allowed only in the tax year the adoption becomes final. Whenever there's employer-provided adoption assistance, in such cases, the employees may exclude from their W-2 earnings any qualified adoption expenses that were paid to the employer, even if the amounts are furnished under an adoption assistance program. And a total amount excludable of $15,950, keep in mind it is subjected to phase out. And a taxpayer can claim both a credit and an exclusion with adoption of child, but cannot claim both a credit and an exclusion for the same expense. So it's one or the other. This brings us to other credits. There are many types of credits directed at individuals, businesses in general, and specific types of businesses, especially those involved in energy products. So individual tax credits include early or disabled, mortgage interest, first-time home buyer, business credit. Include research and experimentation, work opportunity, building rehabilitation, low-income housing, and new markets. Next, we also have what's called energy credits, and there are a number of personal tax credits for energy-efficient products which have been expiring. And by design, they were temporary to create short-term changes in taxpayer behavior. So we have the clean vehicle credit. This is extended through December 31st, 2032. We have the energy efficient home improvement, which is extended through 12/31/2031. We have the residential clean energy credit, which is extended through December 31st, 2024. And then we have the qualified fuel cell motor vehicle credit, which expired at the end of 2021. With the clean vehicle credit, it has two parts. There's $3,750 credit if the critical minerals in the battery are domestically sourced. There's another credit if the battery components are domestically produced. It's not available for taxpayers if they have AGI above certain limits or for vehicles with manufacturer suggested retail price above certain numbers. Use clean vehicle credit of 30% of the price up to $4,000 has been added after 2022 and before 2023. So these are limits on sale prices in the AGI. Something definitely to keep in mind. Oh, and it cannot be claimed more than once every 3 years. So something to also really keep in mind. Next, we have the energy efficient home improvement credit. Taxpayers may claim a credit of 30% of the amount paid for qualified energy efficiency improvements or 100% of qualified residential energy property expenditures. And there are limits based on the type of property installed. Next, we have the residential clean energy credit. Taxpayers may claim a credit of 30% of the amount paid for qualified solar electric, solar water heating, fuel cell, small wind energy, and geothermal heat pump property to 2032, and the credit applies to battery storage technology beginning in 2023. And this brings us to our last credit, the low income retirement plan contribution credit. Certain taxpayers, they may claim a non-refundable low income retirement plan contribution credit, and this is to help encourage participating in tax saving retirement plans. So for example, IRAs. And the credit rates are as follows: 50%, 20%, or 10%, depending on the taxpayer's filing status, as well as their gross income. The credit is a direct reduction from income taxes otherwise payable, and the cash saved may be used to make part of the contribution to the plan. Taxpayers that receive up to a 50% credit for contribution amounts of $2,000, $4,000 if married filing joint, or a maximum credit of $2,000 for married filing joint or $1,000 for single. The credit, it does phase out if the AGI is over a certain income limit, and the low income retirement plan contribution credit, it's reported on Form 8880. So this brings us to the end of Chapter 7, Tax Credits. And now that the lesson has ended, you should have learned how to calculate the tax credit, determine the earned income credit, often referred to as EIC, compute the child and dependent care credit for an individual taxpayer, calculate the premium tax credit available under the Affordable Care Act, apply the special rules applicable to the American Opportunity Tax Credit, AOTC, and Lifetime Learning Credit, compute the foreign income tax exclusion and tax credit, determine the proper use and calculations of the adoption credit, recognize other basic individual credits, and lastly, calculate the low income retirement plan contribution credit.